Hi everyone, welcome to my channel and welcome again to Conceptual Framework and Accounting Standards class. By the way, my name is Marky Garbilio. I'm a certified public accountant and also a professor teaching accounting, auditing, and taxation. Our topic for today is about the second part of financial instruments. And for the overview of accounting standards on financial instruments, we have these financial instrument standards as follows. So we have IAS 32 Financial Instruments Presentation, IFRS 7 Financial Instruments Disclosure, and IFRS 9, which is the financial instruments. These standards became effective for the periods beginning on or after January 2018 and replaced substantially all of the requirements relating to the recognition and measurement of financial instruments in IAS 39, which is the Financial Instruments Recognition and Measurement. In many cases, it will be clearer whether an asset, liability, equity share, or other similar instrument should be accounted for in accordance with one or more of these standards. However, at the margins, determining whether these standards should be applied is not so easy. Firstly, one needs to determine whether the definition of the financial instrument is met. Secondly, not all financial instruments are within the scope of each of these standards. Some are within the scope of another standard, and some are not within the scope of any standard. And finally, certain contracts do not meet the definition of financial instrument are within the scope of some of these standards. For the definition of financial instrument, the main terms used in the standard that apply to the financial instrument are defined in IAS 32. A financial instrument is any contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. In that case, there is a contract because there is an agreement between two parties. One party has the contractual right to receive cash or another financial instrument, and another party who has a contractual obligation to pay cash or another financial instrument. A financial asset is any asset that is a cash, an equity instrument of another entity, or a contractual right to receive cash or financial asset from another entity, or to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity, or a contract that will or may be settled in the entity's own equity instrument that is a non-derivative for which the entity is or may be obliged to receive a variable number of entities' own equity instruments, or a derivative that will or may be settled by other than exchange a fixed amount of cash or another financial asset for a fixed number of entities' own equity instruments. For financial liability, it is any liability that is a contractual obligation to deliver cash or another financial asset to another entity, or to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity, or a contract that will or may be settled in the entity's own equity instrument and is a non-derivative for which the entity is or may be obliged to deliver a variable number of the entity's own equity instruments, or a derivative that will or may be settled other than by the exchange of a fixed amount number of the entity's own equity instruments. Equity instrument, on the other hand, is an instrument that includes no contractual obligation either to deliver cash or another financial asset to another entity, or to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the issuer. IFRS 9 introduces a new classification model for financial assets and financial liabilities. These are actually more principles based compared to the requirements of IAS 39, which was superseded by IFRS 9. The financial assets are classified according to their contractual cash flow characteristics and the business models under which they are held. So example of financial assets, we have debt instruments at amortized cost, which is normally these are debt instruments with the contractual cash flow characteristics. We also have debt instruments at fair value through other comprehensive income with cumulative gains and losses reclassified to profit and loss upon the recognition. We also have debt instruments, derivatives, and equity instruments at fair value through profit and loss. And we also have equity instruments designated as measured at fair value through other comprehensive income with gains or losses remaining in OCI without recycling to profit and loss upon the recognition. Financial liabilities, on the other hand, has two classifications. We have financial liabilities at amortized cost and financial liabilities at fair value through profit or loss. The financial liabilities at amortized cost are the normal financial liabilities. However, for financial liabilities at fair value through profit or loss, any gains or losses attributable to changes in credit risk should normally be recognized in other comprehensive income, with the remainder to be recognized in profit and loss. If there's an accounting mismatch, the entire gains or losses will be presented in profit and loss. On July 24, 2014, the International Accounting Standards Board, or the IASB, or the board, published the consolidated version of IFRS 9 financial instruments, including the revised classification requirements for financial asset classification and financial instruments are accounted for in the financial statements, and in particular, how they are measured on an ongoing basis. The more principle-based approach of IFRS 9 will require careful use of judgment in its application. Some fact patterns have no simple and distinct outcome, and we highlight the factors that need to be considered in arriving at a conclusion. Financial assets may arise from the following instruments. We have debt instruments, we have equity instruments, and derivatives. Under IFRS 9, the measurement categories for financial assets could be at amortized cost, fair value through profit or loss, and fair value through other comprehensive income. For debt instruments, it is any instrument or security that represent a creditor relationship with an entity. A debt security has a maturity date and a maturity value. Examples of debt securities include corporate bonds, PSP treasury bills, commercial papers, and other debt instruments with maturity. A debt instrument is normally measured at amortized cost if both of the following conditions are met. A. The asset is held within the business model whose objective is to hold assets in order to collect contractual cash flows. And B. The contractual terms of the financial asset give rise on specific dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. A debt instrument is normally measured at fair value through other comprehensive income if both of the following conditions are met. A. The asset is held within the business model in which the assets are managed to achieve a particular objective by both collecting contractual cash flows and selling financial assets. And B. The contractual terms of the financial asset gives rise on specific dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. So the application of these conditions, normally we apply the contractual cash flow characteristics test and then the business model assessment test. Any debt instrument that is neither classified or measured as amortized cost nor fair value through other comprehensive income are recognized at fair value through profit or loss.